Will you ever be able to retire? I've got a financial planner here. We're going to discuss it. Let's begin.
This is Debt Free in 30. Here's your host, Doug Hoyes.
Okay, let's get started. Who are you and what do you do?
Thanks, Doug. My name is Rona Birenbaum, and I'm a certified financial planner, and my firm is Caring for Clients. We were one of Canada's first fee-for-service professional financial planning firms. And then we also do wealth management through Queensbury Strategies, which is an independent investment dealer. So we're one of those one-stop shops where individuals get comprehensive financial and lifestyle advice, hands-on collaborative investment management, insurance support, tax planning, all of those kinds of things in one place.
Excellent.
So wonderful career.
Excellent. So, and you were actually a guest on the show. I actually knew your name. I just asked you because that's kind of the format of the show here. But you were a guest back on episode number 215, which was in 2018. We actually did that in my office in downtown Toronto. I'll put a link in the show notes to that. We talked about robo-planners and automated financial planning and a bunch of stuff. But first, we're going to talk about retirement today, but you mentioned that you are a financial planner, okay? Mm-hmm. Now, I am of the view that anybody can call themselves a financial planner or a financial advisor or a money guru. I mean, every idiot has a podcast, right? As you can see on your screen right now. So is this not really just a big scam? So I go to the bank and they say, "Oh, Mr. Hoyes, I see you have $400 in your bank account. Would you like to talk to one of our financial planners?" And I always say no, but if I had said yes, I would meet some guy who watched a 1-hour video when he got hired by the bank, and he is going to suggest that I buy the bank's mutual funds. He's never going to suggest I buy something other than a product that the bank offers. So it is my contention that a financial planner is really just a salesperson. So am I right or am I wrong?
Well, in some ways you are right, because those things do happen. And financial planning is not investment or product sales, but it's very difficult for Canadians to know the difference, right? Because as much as title reform in this country is making progress, the direction that it's headed in, I don't think is going to lead to a heck of a lot more clarity for consumers. And so consumers are going to have to dig a little deeper and ask a few more questions when dealing with financial professionals. Financial planning is not well understood in Canada. As much as we've been doing it for 23 plus years, in general, the vast majority of Canadians have never received thorough financial planning or a complete financial plan. And those who have tend to become advocates for that service and are quite happy to pay for it. So the first step to protect investors from thinking that they're getting financial advice when really they're dealing with a salesperson is to educate them on what financial planning actually is.
Okay, and so we have the same problem in my world because there are all these debt consultants out there who say, "Oh, I can solve all your problems." And so, I mean, I talked to 3 people already today. We're recording this in the afternoon, who had talked to a debt consultant who had then referred them to a trustee. And so what I say to people is, okay, here's a question you can ask. What are their professional qualifications? Are they a licensed insolvency trustee, which is a designation you get from the federal government, or are you just some Joe Schmo? So what are the designations or other qualifications I can look for to see if the financial planner I'm dealing with is legit or not?
Yeah, there are 2 designations that they should look for at minimum. Either the CFP designation, Certified Financial Planners designation, or RFP designation. Either of those at least confirm that there's a certain level of education that they have gone through to get that designation, the continuing education that they have to do on a regular basis. And then they are subject to the Code of Ethics in the case of the CFP, FP Canada. And the Code of Ethics is very clear in terms of our role and responsibility with clients, and that is client comes first. all advice means that we give has to be in the client's best interest. So, for example, if we have a client that has a mortgage and they just got an inheritance, for example, then, as much as it would be more lucrative for us to suggest to that individual to have us invest that money on their behalf and continue to grow their wealth, that in most cases wouldn't be in their best interest. It would be better for them to take all or some of that inheritance and eliminate the debt. Now, if you're dealing with a banker or an advisor at the bank, they have an inherent conflict of interest, particularly if the bank holds the mortgage and would really like to invest the inheritance. So it's less likely to see that bank advisor recommend that the loan be eliminated. I've seen this many, many times, and I'm sure there are top-notch professionals at the bank level whose integrity is greater than their need for compensation, and who then give the best possible advice and tell that client to pay off the debt. But the conflicts of interest are a significant obstacle to the consumer being certain that they're going to get the best advice, and that's a big problem.
And so, why do you not have that same conflict of interest?
Well, we do have the same conflict of interest, but we resolve it in favor of the client.
Yeah, and I guess in your case, you don't hold the mortgage because you're not the bank. But I guess, I'm trying to envision a case where you both hold the mortgage and are doing investments. You're not a bank. But so what you're doing is you're saying, look, and I guess part of it is if you are receiving compensation based on, the work you do, and there are clients I assume you have where you are billing, I don't know if it's by the hour or by the percentage of assets under management or something. Under that scenario, well, it doesn't matter if you put your money in bucket A or bucket B, you're getting paid the same. Is that roughly accurate?
Yes and no. Let me distinguish for your listeners the difference between working with a fee-for-service financial planner that does not get involved with product or investment management or insurance versus the ones that have multiple licenses like myself. Okay. So I would say the majority of fee-for-service financial planners in Canada right now are not interested in product sales at all. They want to do the planning. It is a full-time profession and career, and it's a significant investment in maintaining knowledge and serving clients. So those individuals have no conflicts of interest at all. Okay, because they don't have investments to sell or insurance to sell. They build relationships with trusted individuals in those various spheres that they can refer to on an arm's length basis to implement the recommendations that they give. Okay, now, in my case, I'm one of a number of planners in Canada that have a broader service, wealth management overall, which encompasses everything, the planning, the investments, the insurance, etc. So to answer your question, how do you deal or how do I deal with those inherent conflicts of interest? It comes down to a couple of things. One, my personal integrity and reputation in the industry and within my clients, because my professional reputation and that of my firm is worth more. It's priceless, right? So there's no, product sale that could possibly compensate if I have to trade off my professional integrity and reputation to do so. So that's number one. Now, maybe it's easier for me to say that now that I'm, a well-established business person with a well-established business that, as opposed to when I was starting out with no clients, right? How did I maintain my integrity then? That's just the nature of who I am, and patience. So, not being in a hurry to generate revenue is extremely important. But to do that, Doug, I had to leave the bank-owned brokerage environment. So before I became an independent financial planner and independent wealth advisor, I was with CIBC Wood Gundy. And it was much harder to do in that environment. And so to be able to put clients first and not be driven by compensation targets, I had to actually leave the traditional environment to do that. Now, and that's one of the reasons why I think many advisors go independent. But where we are, there's no sales quotas, there's none of that crap. So I had to find the right firm to run my business through. And then I needed to be patient and disciplined and know that, when you do right by your client, they're clients for life. And it saves a whole lot of time and pain in the long run.
Yep. No, that makes sense to me. I guess there goes the sponsorship of CIBC Wood Gundy. I don't think Wood Gundy. We don't have sponsors here. But if they want to sponsor, they can. I've been doing this podcast for 10 years, and I keep saying, hey, if anyone wants to sponsor not a single person has ever offered to give me money. Okay, so that all makes sense. Now let's get to the topic of today, which is retirement. Okay, something on my mind given my advanced age. So my clients come in to see me. They've got a lot of debt. And so we help them, deal with their debt. And I always say to them, so what's the plan? Well, I would like to have some money to put my kid to school, or I'd like to go on vacation. But ultimately, a lot of people say, and someday I'd like to retire. And that's become harder and harder for people because we've got inflation and everything that's happening in the world. But, retirement is still something we are all looking forward to. And so I say to my clients, well, if you get rid of your debt, then you can actually start saving some money. That's going to make it easier to retire. But what I would like you to explain, and I want you to explain this conceptually, because we're not giving financial advice here. This is not, there's no client relationship here, anything like that. I want you to tell us concepts, okay? So I guess the first concept is, how do I figure out how much money I'm going to need to retire? Like, is there some, and I guess hire a financial planner and they'll help you with it. But conceptually, how do I do that? How do I figure that out? What are some questions I should be asking myself? Walk us through the thought process there.
Yeah, the most important question to answer is what an individual thinks they're going to need to spend. Right? The more you plan to spend or need to spend, the more robust your savings or sources of pension income need to be. And what is considered, a high spending retirement might be considered a low budget for somebody else. And it does require some thinking and some review of how money is being spent. And I would imagine, any of the clients that you've worked with, Doug, you would have focused them on very clearly on their budgeting and their cash flow management. And that is the cornerstone of any kind of future planning. So the first thing is what it's going to cost. And the way to answer that question, because a lot of people say, I have no idea, I've never been retired. Mm-hmm. So the best way to answer that question is to simply say, well, what of your spending is going to continue for sure? And then what are going to be new budget items that either will show up or you would like to have on your annual spending plan? Okay? So, somebody that's in a home is going to have, their home expenses, that's going to continue. Or if they're renting, their rent's going to continue. So all, food, all of those kinds of things. And then it's layering on top of that the wish list, which is, okay, I really would like to be able to visit my grandchildren once a year in the States. So we put a number on that. And I'd like to have a 1 week at a cottage in the summer. Okay, let's put $1 on that. We want to make sure that I have money for future services when I can't shovel the driveway anymore or clean the house anymore. And part of the job of the planners is to help individuals think of all those things, right? Because we've retired many people over the years and we see how their lives change. And it does help inform us and helps us ask good questions of our clients. Many of the things that people forget about are the cost of car replacements. Right? So how often are you going to do that and for how long are you going to do that? What kind of capital improvements or maintenance is your house going to need? Don't forget about the roof needing to be repaired in 15 years. Those kinds of things. So there's the ongoing, just what it costs to live. Then the next thing is, what are those discretionary lifestyle things you'd like to do? And then finally, what we often help with, what are the things that are difficult to quantify, but happen later in life, most typically, and budgeting for those things too. Now, and then it becomes a calculation.
Right. Now, there's one element you didn't mention. So I hear what you're saying. What is it? I've got my base expenses. So the mortgage, the property taxes I'm paying on my house, the rent I'm paying on my apartment, that doesn't change if I'm retired or not. Exact same number. If I want to start going on vacations and traveling, that's an increased expense. Are there any expenses that decline when I retire? And what would those be?
Yes, most definitely. We often find that the costs associated with work, right? So if you're a commuter, then your gas expenses are going to go down. If you work for an organization where you have to maintain a certain dress code, refresh your suit every little while or whatever it is, then obviously those things are going to disappear. If you're in the habit of having lunch out every day when you're at work, or two nights a week, you go out with your friends from work and have a drink, whatever those kinds of things are that aren't going to continue. Yeah, you would eliminate them for sure.
But it's more likely that there will be costs that get layered on because now I can go, in your example, visit my grandkids or whatever. So, okay, so there's obviously a mathematical calculation to be done, and there's no way to do it 100% accurately because I don't know what 10 years from now looks like, but you want to at least start by thinking of everything. And it's really, hey, I got an open book here. What would I like to do if I had an open book? Okay, so there's some math involved. How do you decide? So that was the mathematical end. Now we get into the, I don't know, woo-woo psychology here. How do you decide when to retire? Is it a math question or is it something else?
It's a few things. The math is really a starting point for a discussion. The math tells you what's possible, what's doable, given a whole range of assumptions. So there's what's practical, and then what are you ready for? Right? So, there's some individuals that say, I'd like to retire yesterday. And then there are others that say, I'll never retire because their life is their work. And then there's often individuals that are kind of a hybrid of that, saying, well, I don't want to be working as hard as I'm working now, but I would like to be doing something, just not as much, as many hours, or I'd like it to look a little bit different. So one of the most, illuminating parts of a retirement planning exercise is the scenario comparisons, where we look at a whole bunch of what ifs, which is, okay, what if you retire at age 65, hard stop, no other employment income? We like to start with a full retirement analysis because health can sometimes prevent one from continuing to work part-time. So we want to see, well, when can you be fully financially independent? And then we can say, okay, well, what would be different if you worked part-time for 5 years at, a reduced level of income versus working to age 70? There's all sorts of possible paths to retirement. And we model them all to see what the math and what the data tells us, because only the client is going to receive that information and know how it feels and how it lands with them. Sometimes we'll have an individual that might be anchored on a number. In other words, I'm not retiring until my portfolio is worth X. I think that's a shame, because you're really leaving the retirement timeline decision to something that's completely outside your control, and that can change in the matter of a day or a week or a month. So a lot of the work we do is just helping individuals talk about what they think retirement is, what they want it to be, what their concerns are. Sometimes it's even things like, well, do you want to retire at the same time as your spouse? Like, would that be good for your relationship? Or maybe we should stagger you guys out a little bit, right? Mm-hmm. There's the lifestyle factors, emotional factors, and then the financial ones.
Yeah, it's not just about the money. And you're right, a bunch of this is outside of your control. If your company has a policy that everybody retires at 65, and I don't know if that's legal anymore, but if that's sort of the unspoken rule, well, you gotta do what you gotta do, I guess. Now, you made the comment, what are you ready for? So that's interesting. So you're talking obviously financially, but also whatever the opposite of financially is. So I've never retired, so I don't know what it's like. But it would seem to me that going from full speed to a full stop, that seems jarring to me. Now, maybe it'd be fantastic. I don't know. I guess if I really hate my job, then the sooner I can quit, the better. But are you seeing more and more people who do either a gradual retirement where, you know what, I'm going down to 4 days a week, then 3 days a week, or if that's not possible at my current employer, fine, I'll retire from that job, but I'll go get something else part-time. Is that becoming more common, or is that not a thing?
It is. It's quite common. I think that with the exception of the example you used, where continuing to work where you are full-time is almost a mental health issue or a physical health issue, that scenario aside, individuals by their nature generally have an idea as to how they would like to live in retirement. It doesn't mean that that's how they'll feel when they get there. Okay. But before they get there, it's something that they're typically able to answer, and it typically aligns with how they're living their life now. So, for example, someone might say, well, I'd like to spend more time volunteering. Okay. So volunteering is part of their life even while they're working, but boy, they'd like to do more, right? Or they have, sometimes it's something that happens in their life. You know, I just spent the last 2 years taking care of my aging mother. I'd like to provide that kind of support to others, either on a voluntary basis or in some kind of new business that I create. Or it's, you know, I've only gotten to golf once a week for the last 15 years. I'm going to spend 3-4 days a week golfing. And so what I find is usually the retirement lifestyle, it has an echo of the pre-retirement lifestyle, because people don't just become different people when they retire. There's a continuity of who they are as an individual. And what we like to encourage our clients to do is just do more of what you love already and less of what you don't. And that can sometimes be paid activities or unpaid activities.
Yeah, and what you're also describing, I guess, is you need to practice it. So your example of someone golfing 4 times a week, and I haven't golfed in the last 10 years, so it's not, that'd be great, but it sounds great. But okay, who am I golfing with? Do all my buddies, are also they retiring the same day as me? And how's that all going to work? So, volunteering. Okay, well, if you really like animals, then go volunteer at the animal place now, and maybe you'll find out you're allergic to them and it wasn't such a great idea. I really like kids, but in very small doses, like an hour a year is about right. Even though it sounds conceptually like something you'd want to do. Okay, so I got another financial question for you here. Due to my advanced age, I got a letter in the mail recently from Service Canada, I believe it came from, that said, hey, old man, because you are now 59 years old and the clock is ticking really fast, you're not going to be with us much longer. Would you like to get your CPP starting at age 60, or you can wait till age 70? And as I understand it, if I get it at 60, I get less than if I get it at 70, which makes sense because if I'm continuing to work, I contribute whatever. So how do I find out how much I get if I retire at age 60 or 65 or 70? Can I log into the government's website and find that? Is there some how do I figure that part of it out?
There is a telephone number you can call. If you look at the statement online or you look at what they send you, their estimate of what your future benefits will be, this is for CPP specifically, it assumes that you will continue to earn the same level of income and make the same level of contributions as you have been historically. So it is a mistake to rely on that statement to get the numbers of, well, what if because some people will retire at 60 but not take benefits till 65, or retire at 65 and not take benefits till 70. So the best way to get the actual information is to call Service Canada and say, okay, I'm planning to stop contributions at 60. What would my benefit be if I took it at age 65 or I took it at age 70? Because that's a calculation that takes into consideration your future contributions, which in this example would be 0. And then there are these dropout provisions where Service Canada lets you drop off some of your low income years, et cetera. And so the final number really can't be determined until you either pull the trigger or you contact Service Canada and ask them to let you know based on the scenario that you're describing. The timing of CPP now versus later is one of the most Googled financial questions in Canada. And people have very strong opinions about this, one way or another. Mm-hmm. And so it's interesting.
Well, and to really answer the question, you have to know the future. So if I knew for sure that I was going to live to the age of 92, then I guess waiting till the age of 70 means I'm going to have more money between ages 70 to 92. If I knew that a meteor was going to hit me at age 62, because I'm always standing out amongst the meteors, I guess, I don't know, then I guess take it at age 60 would be the correct answer. Now, if I...
Wait, can I add to that? Because that's part of the answer, right? The second part of the answer is how dependent on that income are you to live, right? Gotcha. So if you and I were sitting together and your retirement sources of income were exclusively CPP and OAS, let's just say that was all she wrote, okay? Thankfully, you're debt-free, which is very important, but you just didn't have time to build up savings. So you're going to have your CPP and your OAS. In that case, if you have a way to bridge between 65 and 70, you would be better off delaying because you're going to have that higher index pension for longer, right? Because you might live longer, right? So just because you don't think you will doesn't mean you won't. So the more dependent you're going to be on that to cover your expenses, the more you have to start hedging towards maybe deferring, providing you have a way of covering the bills in the meantime.
Gotcha. Well, so it is a complicated decision that you actually got to put some thought into. If I continue working to the age of 80, I was going to retire at age 60, but you've talked me into working till the age of 80. So at the age of 70, do I stop contributing to CPP?
Yes.
Okay, so that's the cutoff one way or the other. So, okay. So there you go. I guess I'll just do that. I'll work till I'm 80 now. Now, you mentioned the word debt, which of course is the theme of this podcast. And you made the comment that, you're much better off being out of debt when you retire than not. And I totally agree with that. And I assume you agree with me that that's kind of, not even step one, that's step 0, that by the time you retire, it would be nice if, your debt was paid off. Now, okay, maybe you got a car at 0% financing, so it's not really a big deal or something. But do you agree that the less debt you have when you retire, the better? That's kind of a no-brainer. There's really no argument about that.
Yes, but in the case where an individual, say, is within 10 years of retirement, they're in their highest income earning years. They have no savings. They've just cleaned up their, financial situation, and all they have left is, say, a mortgage, and they're rebuilding. In that case, we always crunch the numbers to confirm this. However, it would not be a surprise if it would be to their advantage to maximize their RSPs versus making extra mortgage payments to ensure that they have no mortgage by the time their employment income stops. It could actually be better that they just kind of, even if they carry a mortgage into, say, the first 5 years or 7 years of retirement, it could still work out to their advantage to actually prioritize RSPs during that, that window that I'm talking about. Because if they're in the top of a high tax bracket, they're going to, for a $10,000 RSP contribution, they're going to save, $4,500 or so in tax. If they then take that and cycle it back into the RSP or put that on the mortgage, then what they're doing is they're building their net worth faster that way. Right. And so in general, yes, but there's some exceptions.
Yeah. And again, that's why you talk to an expert about that. I mean, leverage is great when it works. I guess if your mortgage that you're talking about has a 5-year term on it, great. I know what the interest rate is. I'm locked in. If it's a variable rate mortgage, then that was not a great strategy over the last year or two because you're getting killed. So okay. So there are obviously nuances to everything. So let's close by you telling us, the name of your company again, and how can people find out more about what you guys do?
Sure, thank you. You can find us at caringforclients.com. It's all one word. If you enjoy Twitter, our handle or my handle is at caringforclients, except 4 is the number 4. And either of those places you can find where we're at. And I'll also put a shout out right now for FPAC, which is the Financial Planning Association of Canada. And there are a great list of financial planners that are members there. It's a very collaborative organization. We all support each other for the benefit of Canadians coast to coast. You reach out to any CFP that is a member of the organization. They will either help you or they will refer you to another member who can. We're just making, finances better and education better in Canada overall. Fantastic. And as you've described it before, everybody has their, areas of specific expertise. Some people are, fee-only financial planners, and they do financial plans, and they're fantastic at budgeting and all the planning and insurance and all that. And there's others that are more on the investment side. Yeah, if you're not the person who can help the person, well, then the next person can. So that's absolutely the way to do it. I will put links in the show notes to all of those things so that people can track you down. Rona, thanks very much for being here. It was a pleasure. Great to see you, Doug.
Thank you. So that was Rona Birenbaum. As I said, I will have notes, links in the show notes and to everything she's talked about. And I guess the main point when it comes to retirement, it's not quite as simple as you go to the government's calculator and that's what the answer is. There's some nuances. So you want to make sure you have thought them through. And I definitely agree. The less debt you have going into retirement, the better. There may be cases, as Rona described, where, I'm still finishing off my mortgage or something. That's a lot different than having a payday loan going into retirement, I think. So, lots of information there. And I'll put the link to FPAC as well. That is our show for today. For those of you watching on YouTube, click all the likes and subscribes and everything else buttons. If you've got questions that you'd like to ask for future shows, I'll put the link up on the screen, hoys.com/DFI comments. You can leave a voicemail message there and we will see if we can get to it. Otherwise, if you're listening on the audio platform, same things, like and subscribe. New podcast every Saturday morning. That is our show for today. Until next week, thanks for listening. I'm Doug Hoyes. That was Debt Free in 30.